Good afternoon, everyone. My name is Kim Schoenholtz. I direct Stern's Center for Global Economy and Business, the sponsor of today's event. I'm delighted to welcome you to this panel on financial inclusion. The program will last up to 75 minutes. We'll begin with comments of up to 10 minutes from each of the three panelists. I will then moderate the Q&A with the questions coming primarily from you in the audience. So let me show you what I mean. Please note on the screen on the left that you can submit questions using your smartphone by going to the website www.slido.com, S-L-I-D-O, and entering the code number 7777 in the box labeled Join. Anonymous questions are not permitted, so please provide your full name. You can also vote on the questions that others have submitted. Those votes are on the top right, so even small numbers of votes can change elections. And your votes will help us judge the issues that are of greatest importance to you. Let me now briefly introduce our distinguished panelists. I want to start by thanking Asli Demirgüç-Kunt, who you can see on the screen. Asli spent 5 hours on the runway in DC today trying to get here, eventually going home, and she's now on Skype. And we thank her for doing this. We thank our wonderful Stern IT team for acting really quickly to make this feasible. So thanks to everybody. I'm just going to give them a hand myself right now. So quick introductions. Asli is the Director of Research at the World Bank, where she has worked since 1989. Her research focuses on the links between financial development and firm performance and economic development. Asli founded the global Findex database that is used worldwide to measure progress toward financial inclusion. She is the lead author of the World Bank Policy Research Report, Finance for All, Policies and Pitfalls in Expanding Access, and also created the World Bank's Global Financial Development Report. Asli has been the president of the International Atlantic Economic Society and director of the Western Economic Association. She holds a PhD in economics from Ohio State University. Jonathan Morduch, who's sitting in the middle, so to speak, is professor of public policy and economics at NYU's Wagner School. This is our home professor. He has co-authored several books related to poverty and finance, including Portfolios of the Poor, The Financial Diaries, and the Economics of Microfinance. He is co-editor of Banking the World, Empirical Foundations of Financial Inclusion. Jonathan also is a founder and executive director of the NYU Financial Access Initiative. Having received his PhD in economics from Harvard, he has taught at Harvard and held visiting positions at Princeton, Stanford, and the University of Tokyo. Tavneet Suri, on the far side, is the Louis E. Selly Professor of Applied Economics at MIT, Sloan School of Management. A development economist specialized in sub-Saharan Africa, Tavneet's work focuses on digital financial services for the poor, as well as on agriculture and governance. She is an NBER Research Fellow, editor of VoxDev, an online platform for experts in development policy, scientific director for Africa at JPAL, the Poverty Action Lab, and a board member of BREAD, B-R-E-A-D, a nonprofit organization dedicated to research and development economics. Please join me in warmly welcoming our panelists to Stern. So following alphabetical order, we'll start with introductory comments from Asli, followed by Jonathan and Tavneet. And Asli is going to have to hear me tell her that we've got the slides projected, so just 1 second, I'm going to get that going. And I believe we now, did I put it over here? Yep. We now have, Asli's first slide is up. So Asli, please take it away.
Okay, well, thank you very much. I'm really sorry I can't be there in person, but I really tried. So I can't see the slides, so can we just go to the first slide on why focus on financial inclusion?
You've got it.
Okay, so if the bank we've been working on financial inclusion for over a decade now, and I wanted to just say why we prioritize this topic. Obviously, in development theories, access to financial services is key. It's very important for people to be able to invest in their health, in their education, in business opportunities. Access to financial services makes it easier to manage financial emergencies. And over the last years, there's been a accumulation of quite a bit of empirical evidence through rigorous field experiments that suggests that individuals, especially the poor, really benefit from basic payments, savings, insurance services. There's a bit of a more mixed evidence when it comes to microcredit, promoting investment and entrepreneurship, mostly for households with existing businesses. But we also know that small firms, young startups, for them, access to finance is really associated with innovation, job creation, and growth. So this is an area that we care deeply about at the bank. So for the next slide. In my remarks, I want to focus on two issues. One is the importance of generation of data on financial inclusion. And the other one is to provide help in design of financial inclusion strategies and programs. Now, I wanted to focus on these because I think this is where the World Bank has comparative advantage. We have been trying to sort of focus on getting consistent data to help measure and benchmark financial inclusion. And one of the reasons for this, of course, in addition to facilitating research, is the importance of such availability of data to focus policy attention, because without such data, it's hard to focus policy attention. And this has allowed more and more policymaker attention. And ever since we've started doing this work, actually, we've seen that many governments around the world, over 60 of them, have decided to develop financial inclusion strategies with formal targets and policy frameworks. And again, the bank sort of working globally and distilling best practice lessons and bringing it together with academic evidence is in a good position to try to provide evidence-based policy advice in these areas. So next, please. So let me get to measurement. This is, again, an area we've been working on for a while. Jonathan will remember leading up to the UN Year of Microcredit in 2005. We've been trying to sort of, the first thing we noticed is that there was so little data. It's ironic that there is actually, in the financial sector, there is often a lot of data, high frequency data, but when you try to ask questions like what's the proportion of households or what's the proportion of individuals in a country with a bank account, we didn't have this information, and it was quite difficult to piece it together. Initially, we tried to look at from the supply side, try to look at bank branch penetration, ATM penetration, put it together with household surveys, try to piece together impute data. But eventually in 2011, we were lucky enough to sort of have a partnership with the Gates Foundation and Gallup Corporation. And we started Global Findex, which is actually a user-side database based on interviews with almost 150,000 adults in over 140 countries worldwide, covering 97% of the population. And this allows us to measure financial inclusion in a consistent manner across the world, obviously trying to see how individuals save, borrow, make payments, manage risk, and importantly, whether different groups such as the poor, women, and so on are excluded, to what extent they're excluded. And this, because we do this, data gathering exercise every 3 years, so we've done a 2014 edition, and the 2017 was issued last May, it's possible to see progress, and it's possible for policymakers to track their progress looking at this data as well. So let me go to the next slide where I give you a little bit of the flavor of what we've been seeing. So the good news is we do see that financial inclusion is on the rise globally. So when we looked at 2017 compared to 2014, account ownership rose to 69% of the adult population from 62% in 2014. We do care about the proportion of adults with an account because this is the first step in entering the formal financial system. So in developing countries, the figure is 63%. Comparing to 2011, when we first started this, the account ownership was only about half of the adult population. So you can see that there has been progress. But of course, it varies across the globe, and you can see that there's different shades of blue on the screen, indicating that there's still more work to be done in different regions and countries. So the next slide, please. Just a couple of highlights. I mean, one point that I want to make is how important digital technology has been in driving access to use of financial services. Obviously, sub-Saharan Africa has been at the forefront of this. Mobile money account ownership rose from 12% to 21% in the last version of the database. And interestingly, mobile money spread from East Africa to West Africa and beyond. So, for example, countries like Bangladesh, Iran, Mongolia, and Paraguay, share of adults with a mobile money account now has reached 20% of the population and more. So this is one point. Now, there's also some disappointments. Women are lagging behind. Globally, 72% of men have an account, while only 65% of women do. And this 7 percentage point gender gap was also present when we first started. It was present in 2014, and it's still present now. And when you look at developing countries, the gap is persistent at 9 percentage points. So there is more to be done for women's financial inclusion. Both men and women have been improving, but just there has been this persistent gap. And the other point is looking at the use of accounts. Obviously, ownership of accounts is important, but it's not as effective if nobody's using it. So it's also important to track to what extent accounts are being used. On that, globally, about 20% of account owners have inactive accounts. That means they haven't used it over the last year. And this figure is about 25% when we look at developing countries. But certainly, there's quite a bit of variance. For example, in South Asian countries, this is much higher. In India, for example, almost half of all accounts are inactive, but we need to also keep in mind that India has had a very big surge in account ownership from 53% to almost 80% in 2017. So account use has been lagging. And even here, technology helps. Over the last years, we've seen that in developing economies, the share of account owners using digital payments actually grew from 57% to 70%. So let's go to the next slide. If I just wanted to show you the promise of technology, I think this is a good picture. There's still 1.7 billion adults who remain unbanked around the world. But the good news is 1.1 billion of these people, 2/3 of them, actually have a mobile phone. So I think this sort of captures potentially that the next time we do Global Index, we hope to see a much more of an advancement in financial inclusion. So I think I'm running out of time. In the last slide, I do want to say a couple things very briefly, maybe the headlines on, some of the advice we like to give developing countries in the design of inclusion strategies. I think one of the things that the governments need to focus on is addressing the fundamentals, because financial inclusion is lacking because of market failures and policy failures. And the first thing for governments is to ensure that they focus on alleviating these. So we can talk more about them perhaps in the discussion. The second is something that I've been talking about all along, the important role of technology, but of course, what to do in order to embrace technology and ensure that we make the most of it. And again, there are things that could be done there. And finally, it's also important to emphasize what type of direct interventions are to be avoided, and what are some of the direct interventions that we do see to be useful. The ones to be avoided, I think those are particularly in the credit side. Interventions such as directed credit, subsidized lending through state-owned banks, or debt relief programs tend not to work very well in sustainably improving access to finance and financial inclusion. On the other hand, looking at global findex suggests that policies to expand account penetration, such as requiring banks to offer basic or low-fee accounts, granting exemptions from onerous documentation requirements, providing national IDs, allowing agent and correspondent banking, again, digitalization, seem to be particularly effective in the sense that they're correlated with better inclusion of those segments of the population that tend to be less likely to be included, like the poor and the women. So let me stop here, and then we could continue later. Thank you very much.
Thank you, Asli. Jonathan, it's all yours.
Okay.
And there you go.
Shall I go stand over there?
Wherever you like. It's better.
I think it'll be easier. Thank you. I want to share a few thoughts about financial inclusion from the household side. So Asli just gave us a great overview of how financial inclusion is progressing globally. And we see these incredible increases in access to bank accounts from 50% just a few years ago up to 69% now. It's it's an incredible accomplishment in such a short period of time. But ultimately, the question is, what do households need, and how well are needs being met? As Asli said, 25% of accounts are not being used in developing countries. That's true. And so I want to share a little bit from a few different research projects to give you a sense of how I sort of frame these issues. I want to start with one example from some research called Portfolios of the Poor, which is based on a methodology called financial diaries. In some level, it's a very simple method. It's basically convincing a group of households to share with us every element of their financial life. Every dollar they earn, every dollar they spend, every dollar they borrow, share, save, everything, whether formal or informal. And the example I want to share is from work by Stuart Rutherford, a colleague. And this particular example is of a rickshaw driver in Dhaka in Bangladesh. And this is Hamid, the picture. He and his wife, Khadija, live in one of the slums in Dhaka. And what's striking about Hamid, as you get to know him and follow him over a year, is that on average, his income is about $2 a day. So he's part of the global poor that are living on under $2 a day or less. Right? The global poverty line of the World Bank these days is $1.90 per person per day. But what becomes readily apparent as one follows Hamid's life is that his challenge is not just that he earns, or his family earns $2 a day per person. It's that some days he does really well. He might earn $10 a day. And then for 2 weeks, earn very little. Some seasons, he does well. Some seasons, he does much less well. And so the challenge for Hamid is not just living on such a low income. It's living on an unsteady income and also having unsteady needs. And that reframes how we think about the role of finance and the importance of financial inclusion in the lives of people like Hamid and his wife, Khadija. Here they are in the one room of their house. And if we had asked them what their main financial tools are, they would answer probably quickly some microfinance. Microfinance often is equated with financial inclusion. Like microfinance, a chance to invest, become an entrepreneur. And Khadija, Hamid's wife, does a little bit of sewing, a little bit of embroidery at home. And so she's part of that system. But if we stopped there, we would miss most of what makes Hamid and Khadija's financial life really work. And so as we spent the year, and the research team spent the year with them, we start to see a lot of other financial mechanisms at play. They're borrowing money, they're lending money, they're holding money, they're sharing it, they're sending remittances. They have a wealth of different financial activities that often go under the radar. And so while we look to financial inclusion and the expansion of the formal sector, the fact that there are so many informal mechanisms still at play suggests that the formal sector still isn't providing all of the needs of people like Hamid and Khadija, even though they're included, even though they have microfinance accounts formally and would be included in the global number of banked. What's more, even though Hamid and Khadija are poor, a fairly large share of these activities are actually saving activities. And we start to see that poor households like Hamid and Khadija's are saving not despite their poverty, but because they are poor, because of the ups and downs they need to hold on to money for when things aren't quite so flush. And so it starts to reframe our understanding of not only poverty, but also finance. And a way that we describe this is thinking of poverty as partly a function, I should say the financial elements of poverty as a function of low incomes, and microfinance and other interventions try to address that. But low incomes together with irregular and unpredictable incomes. It's the irregularity and the unpredictability which then creates a lot of the tensions together with the unpredictability of needs, together then with the lack of appropriate financial tools. Right? And that's where finance really can make a difference. And it's really these elements together which drive the tensions and challenges of being poor. I want to turn to another case in Bangladesh, which is more hopeful. And Asli touched on this when she was describing the rapid explosion of digital technologies, mobile money. Tavneet's done a lot of important work here. And we looked at Tavneet's work and the explosion of activity that's happening in Kenya especially, but in other parts of sub-Saharan Africa. But in parallel, there's been growth in other places like Bangladesh. And this is a typical use case in Bangladesh, mobile money used to send remittances. And so this is an advertising for the main mobile money provider, bKash. And you can see that the ad is saying, hey, you're overworked as a factory worker. Life is hard enough already. Adopt this new technology, and it just makes life much simpler so you can send money home not only more quickly, but also with greater reliability and ease. That idea is something we've tested recently. And what we saw also helped us see how mobile money is not just a cool new way to bank people, but it also is making fundamental changes in people's lives. And in many ways, we're building off of Tavneet's work in Kenya. And so we had a project where we were looking at some very, very poor villages. They're usually outside of the formal financial system. And we introduced them to mobile money. at the same time, and it's a very simple setup, at the same time, we were working in Dhaka, in the capital city, where the children of the families in the villages have now migrated, the adult children, to work in the garment factories. And we also connected them to mobile money. And once both sides of the transactions had mobile money, we started to see remittance flows increasing in frequency and in volume. And what we saw happening in the villages was very striking. These poor villages, which really had very little sort of opportunity for income expansion, all of a sudden were getting more money. These are areas where there's a hungry season. People often go hungry during a few months of the year. Once they were hooked up to mobile money, the remittances were helping, and we saw much greater increases in calorie consumption in those periods. So what seems like just a way to move money also turns out to be an important insurance device that really can matter for poor households. The last thing I just want to say is that this isn't just a developing country story. We're doing similar work in the US in low-income areas. This is drawing from work called the Financial Diaries, where we were in California, Mississippi, here in New York, and in Ohio. And we saw something similar. As the labor market changes in the US, workers increasingly see unstable incomes. They have steady jobs, but not steady paychecks. Here are two examples, one from Ohio and one from Mississippi. But we have story after story that looks like that. And so as we turn to thinking about financial inclusion, we see that thinking about people's incomes is obviously an important goal. Thinking about building wealth, obviously an important goal. But what hasn't gotten so much attention, but which is fundamental for households like the ones we've met globally, has to do with cash flows and being able to move money from one point of time to the other point in the amounts needed at the time needed. It's really a liquidity issue as much as anything else. And so finally, as we put this together, we start to see an important element of inequality. That there are citizens who are included in financial systems and have both fundamental steadiness of their incomes and their basic financial lives. They have strong coping mechanisms to deal with problems that arise. And that describes many of the richer parts of not just the US, but Bangladesh, the other places we've been working. But then there's another population that's poorer, but also facing unsteadiness without the tools to deal with that unsteadiness. That's a fundamental injustice in how society is arranged. And it's really that injustice which in many ways financial inclusion is trying to address. So that is the point.
Let Jonathan sit down. All right. Can I see my slides? I can. They're missing pictures. Oh, it's really sad. So thanks for the invite, Kim. It's lovely to be here. And thank you all for coming out in the weather that's out there, which, it started, I was having lunch with someone, it started snowing at like 2, and I was like, it's snowing, and it's the middle of November. So I appreciate you being here. Jonathan already gave a bunch of my work a good intro, so we completely planned this. I'm going to sort of step down a little from both what Jonathan and what Asli did and talk a little bit about kind of the stuff we've been doing about digital financial inclusion. So I'm going to be a little more specific on one set of things that's been going on in sub-Saharan Africa. This is just the growth of mobile payments. I'm going to skip it since Asli gave you a good example of what mobile money and mobile payments look like. And instead, I'm going to talk about work we've done in Kenya over the last pretty much decade now. First around mobile money and then around digital credit. You'll see some stuff that's pretty hot off the presses, not just our existing work that Jonathan referenced. And basically, mobile money has led to this huge expansion in a version of financial inclusion. As Asli and Jonathan both mentioned, in Kenya, pretty much there's universality of mobile money accounts. Almost everybody has a mobile money account, which is a digital payments account on your cell phone. Okay, and that's pretty dramatic to go from 0 or some neighborhood of 0 to 100% in about 10 years. And the way they've done this is they brought the kind of cash in, cash out system that people need around some sort of virtual account closer to people. Okay, and the way they did this is when you do mobile money, you're going to put money in your phone. You need to cash in, cash out at some point. You're going to cash in and cash out not at ATMs or at banks, but at local kiosk stores. These very small stores, you can see a picture over there, and those are going to be your cash in, cash out points. So just to give you the example of Kenya, which is the one I know best, but it's similar in large parts of East Africa. There's only about 1,000 ATMs across the country. There's about 200,000 of those cash in, cash out points. So think of mobile money as providing an infrastructure that's about 200 times as large as the banking infrastructure. Okay, to give some numbers, and I'll show you a map in a second. Today, the average household is about less than a kilometer, 0.9 of a kilometer away from one of those. That's a 10-minute walk. Before mobile money, they were 10 kilometers from a bank, and people are walking. They don't largely have cars. So who's walking 10 kilometers one way to the bank each day? It's not happening, right? So what they did was kind of bring the infrastructure that banking traditionally gives you down to very close to people, okay, which means they can engage with this much better. So let me show you the growth in financial inclusion points, basically, in Kenya from 2007 to 2015. Don't worry about the empty space. There's largely very few people in that empty space, okay? But you can see this huge explosion. And of course, on the right, there's lots of dots on top of each other. The big ones I want to point out are the yellow, which is the growth in mobile money agents. These are those cash in, cash out points for mobile money. And then the pink are banking agents of some sort. So banks have kind of jumped on the bandwagon with mobile money and realized, if you can't beat them, you join them. And so they've started to create agent networks through some businesses to provide deposits and withdrawals for the banking system. Okay, so you've seen this huge, huge increase in sort of access to these financial service points. Let me tell you what mobile money did in Kenya, and I'll explain this picture in a second. This was kind of the first part of our work on mobile money in Kenya. It's called M-Pesa, which is M for mobile. Pesa means money in Swahili. And so what we looked at is this concept of financial resilience, and both the previous speakers mentioned this. One core component of financial inclusion or financial well-being is resilience. When bad stuff happens to you, how can you manage it? Can you manage it and can you deal with it? Okay? And in the developed world, we have two ways of doing this. I buy private sector insurance, so I either buy healthcare or my employer gives me health insurance in some way. Or we have social safety nets from the government, right? So when I get unemployed, there's unemployment insurance from the government. When there's some disaster, there's emergency relief from the government. Both of those are largely absent for large segments of the population in Africa. The government doesn't provide extensive social safety nets, and the private sector is largely too expensive for most people. So what do people do? They kind of form these informal insurance networks. So what do? I make a deal with Jonathan, and I say, hey, Jonathan, if something bad happens to you, I'm going to help you. But then when something bad happens to me, you return the favor. These networks are not caused by mobile money by any stretch. We have a running joke in development that you can't be a development economist without having written a paper on this phenomenon existing in some random country. And so we know these networks exist. We know these processes exist because people have to deal with risk in some way, right? And so what happened when mobile money came was all these sort of informal agreements, like when something bad happens to Jonathan, right, I have to get him money. Right? I have to actually get it to him. And so when mobile money came along, all these transactions came onto the mobile phone. Before, what would I do? I would actually travel to Jonathan's house and try and get it to him, which is actually quite expensive. And the further away he is, the more expensive. Or I would give it to a bus driver. I'm going to pick on Mike because he's the other person I know in the audience. My bus driver looks like that. I'm not sure I want to give him my money, right? Will it get to Jonathan? I don't know. Okay, so it was in this informal system handing money to people to deliver for you. Okay, and this turns out to be expensive, not very safe, not very efficient, not very quick. In our first round of data, when mobile money first started, the average transaction travels about 200 kilometers. In Kenya, that's a $5 bus ride, right? It's quite an expensive thing. So the advantage of mobile money was now it didn't matter what the distance is. I pay 35 cents a transaction, the money goes off. I don't know, it could be 35 cents if I'm sending it to Kim, who's sitting next to me, or 35 cents if I'm sending it 1,000 kilometers. So you kind of broke that sort of distance barrier. So what this graph is just saying, look, let's see what happens to people when a bad event happens to them. And I picked out kind of a health event. That means someone in your house, your kid or your spouse or someone living in your house got sick. And the way we kind of think of resilience is we look at your expenditures and say, did you have to kind of cut stuff out of your expenditure? Did you have to change some way you were spending your daily life? Okay. So when we have a health event, I'm just going to show you what happens differently for the people who had access to mobile money and those who didn't. So what happens is in the guys who have mobile money, their expenditures are all going to go up. There's two things to note. For the people who have mobile money and don't, they spend about the same amount on medicine. Okay, so it turns out if you're rich or poor, whatever is happening in your life, if someone gets sick, you go figure out a way to spend some money to get them better. So we will always find that health is a very important priority for these people. For the people who don't have mobile money, where does that money come from? They're going to cut it out of other parts of their budget. So they take it out of non-food, which is schooling in this case, and they take it out of food. For the people who have mobile money, they're able to not just spend on medicine, but they're able to spend more on food, right? So you've all taken medicine from the doctor, take with food. Turns out a very, very important part of health is food. And you'll see basically not only do they spend on medicine, they're able to spend on food and non-food as well. Okay, and what we see in the data is why is this? Why are they able to actually improve kind of what they're spending? It's because they can reach out to more people on the cell phone. They're more likely to receive money, they receive more money, and they receive from more different people. Okay, so by making the transactions cheaper, quicker, more efficient, I'm getting more transactions, right? Instead, I was spending $1 to get money to Jonathan. Now I'm spending 30 cents. I can send that extra piece to him now too, right? Because I'm not spending it on transactions. So this is kind of the improvement in resilience we saw in mobile money. Kind of as a result of reducing transaction costs so dramatically, you see this improvement in how resilient, how financially resilient people are. And then we went back a few years later and said, okay, if you're more resilient, we should see bigger, longer term effects, right? So everybody, I'm sure, has heard the higher risk, higher return. If I'm better protected against risk, I expect to be able to take advantage of higher risk, higher return opportunities because I know I'm better protected. I know Jonathan's there, I know Mike's there, I know Kim's there, so I can kind of do high risk things. So we see this about 5 years later, we see a reduction in poverty of about 2 percentage points because of M-Pesa. That's about 196,000 households, just under a million people moved out of poverty. And we also see women switch occupational choice from agriculture into retail. Okay, that's the higher risk, higher return. Okay, for the last 2 minutes I have, I want to talk about something new, which is once mobile money is there and everybody has an account, the banks have been layering on digital bank accounts. So these are fully digital bank accounts. What do? I take my mobile phone. By the way, these are all dumb phones, not smartphones. Okay, so we're still in the old Nokia brick land. And they're going to open up a bank account, okay, a completely digital bank account. If I want to put money into my bank account, I'm going to use the rails of mobile money. I put it into my mobile money account and then move it across costlessly. If I want to withdraw money from my bank account, I move it from the bank account to my mobile money account free, and then pull it out of my mobile money account the usual way. So basically, once mobile money has set up all this infrastructure, right, all the accounts and all the cash in, cash out points, I can layer on a digital bank account, okay? Now, the beauty of this for the bank is no tellers, no branches, no loan officers, no nothing, right? It's completely digital. For people, they don't have to go to a bank branch to deposit money. They don't have to go to a bank to ask for a loan. The minute you open your account, there's a back-end scoring system that is based on data on your transactions. It gives you a credit limit. You borrow up to that credit limit, et cetera, et cetera. Everything is completely digital. I request a loan. It comes into my account immediately. Because the minute I opened an account, they told me your limit is X. So up until that point, I can borrow. So there's now 15 digital lenders in Kenya. You can see what the major ones are. But just to give you a sense, the biggest one is one called M-Shwari by the Commercial Bank of Africa. 70% of Kenyans now have a bank account on M-Shwari, okay, a digital bank account on M-Shwari. And about 30% of Kenyans have taken a loan on M-Shwari. Okay? So the last piece I'll tell you about is a piece we did around M-Shwari and trying to understand the impacts M-Shwari has on people. And we're going to see actually very similar results to mobile money. We see an improvement in resilience, and we see an ability to spend more on education. And again, it's the same idea. If they don't have the resilient piece, if I can't take the loan out when something bad happens to me, what am I going to do? I'm going to cut education and spend on health. Most of the emergencies are health-based. They're taking out the loans and spending them on health, right? But if you didn't have that loan, you'd be cutting education. So again, with M-Shori, we're going to see the same piece. We see an improvement in resilience and an improved ability to pay for education, okay? So basically, I think digital tools have been able to come through and not just expand financial inclusion, but really improve financial well-being. Okay, there's still lots of room to go because the loans are small. They're not quite giving people enough credit. But the first step, I think, has been able to expand access and inclusion in this way, in a very particular way for people, to be able to provide them some form of resilience. Okay, I'll stop there. Happy to take questions, comments.
Thank you so much. So, first of all, thanks to all of our speakers. That was great. We're now at the stage where I'm going to, whoops, if I don't get this right, I don't want to cut off the Skype line. We're going to switch to Slido and hopefully display full screen. There we are. So what you'll notice is, once again, you can go, this is how you submit questions. Go to slido.com, 7777, submit questions and vote for the questions. Your votes will change the ordering of the questions. So, Asli, I'm going to say them out loud to make sure you can hear them, and you can, if you want to jump in, please just make a loud noise. First one is about people who have, let's say, recently become banked. And we saw from the wonderful Global Findex data that quite a few people, a quarter of those who've become banked in the developing world, don't use their accounts. They're inactive. So the question is really, what are the most effective ways to encourage use of financial services? So Asli, I don't know if you want to jump in. I'm sure there will be people here who do, but I'm giving you the first option.
Sure. Digitalization is a very important way in we could promote greater use. For example, 1 billion banked adults still make utility payments in cash, and 900 million of those have a mobile phone. So there are some low-hanging fruit here. So 300 million account owners still get their private sector wages in cash. 275 million people get their agricultural payments in cash. So if the governments were to move wages into bank accounts, the private sector were to do that, if it was possible for individuals to make their utility payments through their accounts, I think this would get them into using their accounts much more. And we do see individuals are starting to actually make use of these digital use of their account much more. But I think there is much more to do, and this is the one area where we can make quick gains.
Great. Did either of you want to jump in?
Yeah, I mean, the most obvious thing is to make them more useful. And I think that's part of the problem. You've got lots of accounts, but they're not particularly great accounts. Yeah, they may be bank branches where people feel uncomfortable coming in, particularly if they're a certain ethnic group or income group. And so there's a long way to go. One of the exciting things I think about digital is that in some ways it's cutting through a lot of that and creating other possibilities for people to gain access without having to deal with some of the social barriers to physically being part of the system. But the contracts also can be problematic. The prices can be high. I think the problems are often structural and need structural responses.
I don't think I should let Jonathan go before me. I think we need to alternate. We're too close in what we do. I mean, my answer was exactly his, which is give people stuff they need and want, right? A bank account and a loan is not going to fit every one of every poor person's needs and wants, right? So even digital credit, much as there's 15 lenders, they offer exactly the same product. Every single one of the 15 lenders offers a monthly loan at X%, approximately, right? There's no reason that there should be one product once you're digital. I'm going to get data on you. I can tailor. I can do so many things. Yet there is still just one product. So I think some of the use is about people thinking that I need to provide one thing and everybody should use it. And that's just not reality. Different people need different things and want different things. And so I think tailoring is really important.
Great. None of you mentioned in your answer financial literacy programs. Are they not particularly helpful in getting people to use financial services? Asli, I'm going to start here first. But since you did
Jonathan, you can take that one.
Let's turn it over to you.
Oh, I can take that one. I'm happy to take that one. I think it is hard to find financial literacy programs that have impacts on people's lives. I think that's the general, what we've learned broadly. There's a couple that have worked, but it's really hard. And I think partly that's because, I don't think it's because financial literacy is not important, Kim. I'm sure it's important in my gut. It's that we can't take a bunch of people and put them in a classroom for a day and expect them to have learned something in this environment that we're used to, in a way we're used to. So I think on financial literacy, this is just an opinion not based on any evidence, is that we kind of need to think very creatively about how we do financial literacy. There's been some interesting RCTs in the population, in the poorer population of the US, trying to use edutainment and gaming and stuff like that to do financial literacy. We haven't tested any of that in the developing world yet, but my sense is that's maybe a promising avenue to go.
Yeah, I mean, I was just in Brazil earlier in the week in Sao Paulo at a conference on financial literacy and education. Brazil's got a problem, a huge problem with debt. Just many, over half the population is over indebted. And so there's great interest in financial education, especially on the part of banks. But in this conference, there was a pretty big part of the audience that felt like, you know, this financial education push is simply pushing responsibility for over-indebtedness onto the shoulders of the customers, where it partly belongs. But part of the problem is also products that are being marketed in ways that are maybe not appropriate, products that are not particularly well designed, that are targeted to vulnerable populations, sometimes with teaser rates that then go up and catch people unaware. So I think there's a supply side to this story and a demand side. And the problem that financial education is trying to solve can't be solved only by financial education. It also needs these supply side interventions and consumer protections to really work.
Asli, did you want to add anything to that?
Just very briefly, I think that financial literacy is very important to ensure responsible use of financial services. I mean, I think there was much more emphasis on this after the subprime mortgage crisis, but I do agree that from the research that I've seen, it's not easy to sort of provide financial literacy training through the usual classroom setting. We are still trying to learn how to do this well through well-designed targeted interventions, whether it is taking advantage of teachable moments when people are trying to say, for example, buy a house, provide the information that's around that, or leveraging social networks. If you're teaching the students, also teach the parents, remittance senders, remittance receivers together, or applying rule of thumb type of training to prevent information overload. And as Tavneet mentioned, innovative delivery channels such as entertainment education seem to hold promise. And there is something we've done in South Africa that sort of suggests that there could be promise through use of such channels. But indeed, we do need to do much more work in this area.
Great. I'm going to adjust some of these questions to fit what you guys have talked about. So Jonathan, you had mentioned in the experiment you were doing, I believe in part of Asia, that you had brought access to mobile banking to both sides of a transaction, people in the village, people in a working area. what did you have to do? What did you have to overcome to get them to start using that mobile technology? Did you have to pay them in some way or provide a subsidy? What was the mechanism?
Yeah, it's an interesting question. It turned out that by targeting a population that really could use the product, it didn't take much more than sort of sharing with them how it worked. What was sort of more striking to us was that the provider, Bcash, the biggest provider, had put in place a series of barriers that were keeping people from adopting. For example, they were, as Tavneet was saying, everything's on basic Nokia phones, but the menus were all in English. And a lot of the unbanked are not so literate, and especially in English in Bangladesh. No one speaks English, much less Bengali. And so, simply translating the menus, right? Simply giving some hands-on experience. That was really most of what it took. And then they saw the use, and they grabbed hold of that.
Is that consistent with your experience, Tavneet, elsewhere, that it just doesn't take much for people to start using mobile technology if they have the basic information about it?
Yeah, absolutely. I mean, mobile money kind of seemed to take off, even at least in Kenya, pretty easily. I think most of the pieces are not just the piece Jonathan talked about, but the business model side. I need cash in, cash out points at both junctions. If there were no cash out points in the villages, you're just done because they can't get money back out. And because initially not everybody's using it, there's nowhere to spend it. So I think understanding that you need cash in, cash out everywhere is part of that piece. If people can cash in, cash out. I will say people have some reasonable faith in the telco. I'm not saying they should. Yeah. I'm not telling you whether that's good or bad, but it is a very prominent part of people's lives because they've been using phones and communicating, and buildings are painted in the colors of the telecommunications companies, and there's some sense of presence in your everyday life in a way that the bank doesn't. The bank used to be 10 kilometers away. The telco was selling airtime 2 minutes from your doorstep, right? It was selling you phone credit. So I think that helps a little with the mobile piece. We're just running an experiment now in Kenya where we took a bunch of people who had data-enabled phones. This doesn't have to be a smartphone. You can get the internet on a non-smartphone, and gave them internet for the first time ever. They'd never used data before, and we gave them a whole ton of data over the last year. And take-up rates are over 50, 60%, right? So imagine someone who's never used the internet, and I just SMS you and say, you have some free data, and we sent them a set of 10 text messages on how to use the internet, but literally just 160 characters, 10 messages, and 60% of people were using it, and up to the average of the average user in the country, right? So not just a little bit. And so it seems like it takes very little push to get people on. Of course, we paid for the internet, right? But given they'd never been on a browser, never used anything, a bunch of text messages and paying for it, managed to get them on it. I think that sort of fits the same idea.
Just to elaborate on that, it sounds like there are some really important network effects. Obviously, the value grows when there are more cash in, cash out points and more people using it. So making the network thick actually adds value, and it presumably attracts people. Asli, that brings me to the question of whether it might make sense for countries to try and kickstart this process of creating a network. And the obvious example I've got in mind is India, where you have the biometric ID process, the remarkably low-cost, no-frills accounts. As I understand it, more than 300 million accounts have been created in the last 4 to 5 years. How much does that network effect in places like India matter? Asli, I don't know if you want to jump in on that.
I mean, I agree that it's been a huge experiment, and it's been quite interesting to watch. And the national IDs and the network effects have been very important. But also on that, I think India has been criticized because, as Jonathan was mentioning, a large proportion of those accounts have not been used. So on the one hand, the usefulness of these accounts is something that we need to look at. Whether providing these accounts to the state-owned banks is another issue. But obviously, it could also be lagging that individuals will start learning how to use these accounts over time. In 3 years, just going from about 53% to close to 80% is a huge accomplishment. Even though half of those accounts are still unused, and we need to see how these things proceed.
Great.
Can I
Anybody else?
add
Yeah,
one
please.
thing there?
Yeah.
I think the UPI, the Universal Payments Interface in India, might be game-changing, right?
Yeah.
Similarly, in Kenya, you feel like a lot of innovation. I am actually disappointed in Kenya. If you think that by 2014 there were universal universal mobile money accounts, we've had one banking product. That's pretty bad. And I think part of that was you couldn't access the rails of mobile money very easily. You had to go hang out at the telco and negotiate with them, and there's this behemoth of a guy. So they've released an API, if everybody knows what an API is. I think that's going to be the way we get use up. We can create innovations, but we also need the rails to be available. So I think this growth in APIs, so trying to get telcos to use APIs to give access to their assets to innovators and entrepreneurs will be important. The UPI in India, this Universal Payments Interface, is a bit of that, where the government's like, we're going to take it on. We're going to do a payment infrastructure that links bank accounts through cell phones, and we're going to make it super uber cheap. It's extremely cheap. So that might sort of try to jumpstart this use piece of it.
And once you have the network, it becomes self-fulfilling
Yeah.
in some
Exactly.
sense, right? Okay.
Exactly.
On the government side, there's also a careful navigation about regulation, right? You want to make it easy for innovators to move, but there's a lot of risk involved, and so at some point you need to put more barriers. And getting that right has been hard. Kenya was very open, and I think that really helped M-Pesa, but then it started to shift.
Actually, I don't think so.
Yeah.
I don't think it was just the government. I actually think the business model mattered more. If you look at Uganda, they didn't have the right business model. The entire system collapsed and had to be rebuilt, right? So I think that was very important.
Yeah,
Other
I'm
than
not,
the
not
piece
saying
of...
it was sufficient.
Yeah.
I'm just saying that it created space for something to happen.
Correct. Yeah. I think there's still some countries that just simply don't allow it. So in that sense, absolutely. Yeah.
One of the questions from a student is about understanding why there are still very big differences across regions in financial inclusion. And we could talk about the role of the state, the role of technology, the level of income. If Asli, I don't know if you want to jump in, but an example would be the Middle East is relatively low in terms of financial access. What are the reasons you would attribute there for that difference compared to other parts of the emerging world?
That's right. I mean, when we look at the world now, almost half of all the unbanked live in 7 countries, right? China, India, Indonesia, Mexico, Nigeria, Pakistan, and Bangladesh. Some of these countries have been making great sort of strides, but still, obviously, because of the population, they are still representing a large part of the unbanked. When we look at regions, we have sub-Saharan Africa still around 43%, and Middle East, again, 43%. So why are they lagging? Well, when we do ask the unbanked what are some of the reasons that they do not have a bank account, the most common one is that they just don't have enough money, and the next one is that they don't need the accounts. But then they also go ahead and provide reasons such as high cost, not having the right account, the right product that fits their needs, distance, lack of trust, religious reasons, all these things add up. And when you take those out, the proportion of people who do not want an account drops to only 3%, for example. So in the Middle East, I think there are still issues vis-a-vis trust in the financial system, not having the design fit the needs of the individuals, particularly the religious issues come in. Also, still costs and distance are reasons that are given. And obviously, the infrastructure is not there. There is an important role for the government to play, as I mentioned, because when we think about inclusion, I mean, some people just don't want to use the account. Some people shouldn't because they're not good credit risk, for example. But then there's a huge group that are excluded because of market failures and policy weaknesses. So it's important for governments to address weaknesses in information systems or weaknesses, improve the legal and regulatory frameworks, which is enforcing contracts and creditor rights. Again, Middle East is not doing as well in these areas. Another thing that is often not sort of emphasized enough is the lack of competition among the existing financial institutions, because by laying this framework, the public sector would be able to provide the incentives for the private sector to adopt new technologies and new innovations in order to improve access to finance both sustainably and profitably. So that's
great. Anybody want to jump in? Or okay.
I think she got that covered well.
I think so too. Actually, risks. It's come up several times in the discussion. One of the students is asking about what are the risks associated with rising financial inclusion? What should we worry about?
I'm happy to. You want me to do it? Okay. Well, I can talk about the digital side if you want, because I think that's where most of the financial inclusion is actually coming in, at least in sub-Saharan Africa, which is where I work. I won't talk about the rest too much.
I could talk about the rest. So.
Okay, good. Awesome. Tag team with us today. On the digital side, I think there's a piece around consumer protection that's really, really, really important. At least in sub-Saharan Africa, signing something is a really big deal. It's a really big deal because people worry that they're signing their land away to you or something big. And so when you usually get a loan at a bank, you have to sign something. This is a really big deal. They go read it. They get everybody they know to read it before they're going to sign it. With the, like Mshwari is talking about, you just say accept terms and conditions. How many of you read your Google Play Store terms and conditions? You might want to on the Google Play Store. But we all say accept, right? We don't read them. But we have institutions, we hope, that protect us. You know, I think, well, if something goes wrong, someone else will figure it out and there'll be a lawsuit. But in developing countries, when you don't have those institutions, I worry a little about people saying accept and just doing something without really understanding what's there. So I think the consumer protection issues are going to be salient and get more salient as there's more products coming over your phone and people can just get them. You know, this indebtedness that Jonathan talked about might be a part of that. We're still really far from it, sub-Saharan Africa, because people just don't have very much credit. But you don't want to get to the point where it's really bound to fix it. So I think that's another piece of it. And then there's a piece around data protection, data privacy, and data ownership. You know, as people start to use a bunch of the data that the telcos and the banks have, who owns that data? Who gets to decide how to use that data? I think those all start to become issues that we want to be careful about and think carefully about.
Okay. Asli, did you want to jump in?
Yeah, sure. I mean, in the circles that I operate, often when we talk about financial inclusion, there's this potential cost that is brought up in terms of stability. So the idea is that financial inclusion shouldn't mean finance for all at all costs, because not all services are appropriate for everyone, particularly when it comes to credit. And we do know that there is the risk of overextension when credit starts expanding without paying attention to the credit worthiness, and then things can go wrong. One of the examples that everybody remembers is the subprime mortgage crisis, but it's not only in the U.S. that we've seen this all around the world. For example, the microfinance crisis of 2010, where rapid growth of loans without an appropriate institutional infrastructure made microfinance borrowers borrow from many microfinance institutions. They became over-indebted. There was a lack of a personal bankruptcy scheme, and then also a promotion of a credit culture that allowed for borrowers not to repay, particularly during election times. And then it all ended up becoming a crisis. So the point here is, I think, one needs to be very careful when it comes to credit type services, because this type of crisis risk is always lurking there.
Okay. Actually, fintech is a big topic at business schools, and we've heard a good bit about it today. This question is about fintech in the United States, and specifically about some of the startups that are operating. Are they doing much to affect the unbanked in the U.S. and the underbanked in the U.S.?
That's all Jonathan's.
But there are lots of startups doing all kinds of things. I mean, some are
Yes.
helping us invest better and more cheaply, and those aren't really helping most people who are poor and aren't investing in that way. So those ones aren't, but there are some which are really trying to provide better services to low-income families. So it's a real mix. There are obviously more that are helping people invest than are helping low-income families, but there's some really cool stuff happening. Like there's a company called Even that we got to know, which is helping people, low-income people, manage the ups and downs of their incomes through an app, a bit like Mint or another aggregator like that, and helping them figure out how much they can spend and not spend. There are other apps that are helping people get hold of their next paycheck more quickly, called PayActive, which is helping people then reduce reliance on payday lenders and things like that. So there's a lot of possibility with fintech for the low-income sector.
Great. Asli, I'm not sure did you want to add anything on that?
Actually, I should look into them. I haven't really. I saw that question and I sort of Googled them and I found out about them. I just don't know as much about them to be able to say much.
No problem. The question from Professor Saeed is about what we can learn in the United States from developments abroad in the emerging world and vice versa. Are there gains from traded knowledge about how to address the unbanked and the underbanked across the U.S. and emerging world borders?
I'm happy to start, Jonathan. It's up to you, whichever way you want.
Yeah, I think we can kind of split this question maybe. But
Okay, go for it.
Okay.
All right, I'll start. So I think there's a piece of the mobile payments and digital finance story in the developing world that's hard to replicate here. Partly because there wasn't a ton of regulation there. So actually, when we started working on mobile money, we met the people at the Fed who work on payments, and they said, oh, we would do this for the unbanked. And when we started to explain how every piece of the puzzle worked, they went, oh, can't do that piece, it hits this regulation. Can't do that piece, it hits this regulation. Oh, can't do that piece. And I was like, okay, I'm just going to stop. Like, there's no point going any further. So I think in environments that don't do a lot of crazy financial transactions, there's not a lot of regulation, which means you can build the regulation you need for this stuff. I think it's hard to import that here because all the pieces hit up against some existing regulation. That said, I think there's some pieces that are applicable, right? Social networks matter a little, and in the US, we've largely not integrated that into financial systems, except for maybe Venmo or something, right? But the reason Venmo seems to be popular is because we have social networks and they matter. So I think there's some pieces of the puzzle that we can bring back and try to think about how we can be creative about those and providing benefits to people that fit our regulatory environments. Jonathan?
Yeah. You know, it was interesting. I am like Tavneet, a development economist. Spent most of my career thinking about India, Bangladesh, and then coming to work in the U.S. I was surprised at how relevant the kinds of tools and frameworks that we have, how applicable they were in poor communities, low-income communities here. And so just to build on what Tavneet was saying, for example, when we look at credit in the families we got to know here, credit cards were the number one biggest source of credit. But number two was loans from family and friends, right? And so as a development economist, it's like, yeah, we can talk about that. We even saw Roscas and things like that. So there's a lot going on like that. And as Tavneet said, you can start to think about developing financial products that have social elements that really can function. We don't have much innovation like that here. The other thing going the other way is that in the US, we think a lot about long-term financial products like retirement products. Those are becoming more important in lots of places. The whole world is aging. In Brazil, that's a huge concern with their retirement system. One of the things we see here that's being experimented with is how to address a problem that people are putting money into their retirement accounts and then they're taking it out, right? It's becoming a sort of short-term savings vehicle, particularly for low-income people. And one of the innovations that people are experimenting with, both in the US and UK, is a retirement account that you default into while defaulting also into a small emergency savings account on the side, so you can dip into that instead of having to touch your retirement accounts. So I think there's a lot more thinking and experimentation on that side in the US that will be very relevant to at least some subset of developing economies.
Right.
Yeah.
Yeah.
Asla, I think we're
on the US, I think it's interesting to look at their proportions. About 93% of the adult population appears to be banked in terms of having a bank account. Obviously, that could be higher because in the same range of countries, you do have a lot of countries with 100% banked. But when you look at, what reasons individuals give for being unbanked, they are very similar to, again, developing countries. Basically, most of them say they just don't have enough money or they do not need one. And then the most important reason that overlaps with that is that the required balances and the fees and the accounts are just too costly. So I imagine, again, low-fee accounts or simple no-fee accounts could help, and financial awareness programs could also help. Maybe sometimes people think that they don't need an account and they don't understand how to use it, and that could help.
Asla, I'd like to, for the last question today, I'd like to turn to you to give to answer the question about the World Bank's goals for financial inclusion. My understanding is the aim is to eliminate the unbanked in about 2 more years. That strikes me as a little bit ambitious, although ambitious goals are useful. Where do you think we're headed? How quickly can we have the number of unbanked that we see today, 1.7 billion in your latest Global Findex?
Yes. Well, that's an ambitious target, as you've mentioned. I hope we make advances towards that target. I will not try to forecast how soon we can meet such a target.
Okay. Anybody else want?
No, definitely not about the World Bank.
Okay. Well, I hope everyone will join me in thanking our panelists today.